If you're a UK pensioner, or you're about to become one, there is a very good chance your next payment is going to be different from what you expect. Not because something has gone wrong, but because the rules around your pension have quietly shifted and almost nobody explains them properly. Today, I'm going to walk you through exactly what's changed, what you need to check before your next payment lands, and the mistakes that are costing pensioners real money right now. Stick with me until the end, because the last point could genuinely put hundreds of pounds back in your pocket. Let's start with the number everyone's talking about. As of April 2026, the basic and new state pension were uprated by 4.8% from April 2026. That sounds like good news, and in many ways it is. But here's the part most people miss. The full rate of the new state pension is now £241.30 per week for the 2026-27 financial year, but you may get more or less depending on your national insurance record. That word may is doing a lot of work. Millions of pensioners assume they're automatically getting the headline figure, and they're not. Having more than 35 qualifying national insurance years doesn't boost how much state pension you receive, and the only way you might get more is if your starting sum under the new rules is higher than the current maximum. So if you've never actually checked your national insurance record, that's rule number 1. Go and check it, because the gap between what you think you're getting and what you're actually entitled to can be significant. Now, let's talk about who qualifies for the full amount in the first place. To get the full new state pension, you need at least 35 qualifying years of national insurance contributions. If you're on the older, basic state pension system, the rules are different again. The full basic state pension for this tax year is £184.90 a week, or £9,615 a year. And to claim the full amount, you usually need at least 30 years of contributions. Notice something important there. Those two figures are not the same. If you're on the old system, you are, by design, receiving less than someone on the new system, even with a full contribution record. This catches a lot of long-term pensioners off guard, especially those who assume the headline £241.30 figure applies to everyone. It doesn't. It never has. And this leads directly into one of the biggest myths in the entire pension system. A financial planning expert put it plainly this year, warning that millions of pensioners will not actually receive the estimated full new state pension payout, and that generally, the older you are, the more likely it is your payment will be lower than the headline rate, sometimes substantially so. So if your neighbour is telling you everyone gets over £12,000 a year from the state pension, that simply isn't accurate for a huge portion of pensioners. Your actual entitlement depends on your personal contribution history, when you reached pension age, and whether you were ever contracted out of the system. Morningstar. Speaking of being contracted out, this is rule number 2, and it trips up more people than almost anything else. If you were contracted out before 2016, you will usually need more than 35 qualifying years to get the full rate of the new state pension, because while you were contracted out, you or your employer paid more into your workplace or private pension and less into your state pension. If you worked for a company with its own pension scheme at any point before 2016, particularly in the public sector, banking, or a large corporate employer, there's a real chance this applies to you. It's not a penalty, it's just how the maths works, but if you don't know it applies to you, your forecast can look confusing and your payment can look lower than you expected for no obvious reason. Now, rule number 3, and this one is about timing, not amount. Your state pension age is not fixed at 66 for everyone anymore. The state pension age is currently 66, but it will rise to 67 by 2028, and then to 68 by 2046. If you were born after a certain date, your pension age has already shifted, and if you're younger, it's going to shift again. This matters enormously for planning. If you were born between the 6th of October 1954 and the 5th of April 1960, you can access your state pension at 66. If you were born on or after the 6th of April 1960, that gradually increases to 67. And if you were born on or after the 5th of April 1977, your state pension age is set to gradually increase to 68 between 2044 and 2046. This isn't something you can afford to guess at. If you assume you're getting your pension at 66 and you're actually not eligible until 67, that's a full year of income you thought you had that simply isn't coming unless you plan around it properly. Here's something a lot of pensioners don't realize they can do. You are not obligated to start claiming your pension the moment you become eligible. You can defer your pension to increase your payments, and you can also continue working past your state pension age while still choosing when to access it. And deferring isn't just a symbolic choice, it has a real financial impact. If you delay claiming for at least 9 weeks, your payments increase, and for every full year you defer, your weekly pension rises by just under 5.8%. That's a meaningful boost, permanently added to your weekly payment for the rest of your life. Now, deferring isn't right for everyone, especially if you need the income immediately, or if delaying would cause you to miss out on other benefits you're entitled to. But if you're still working, in good health, and don't need the money straight away, this is a rule worth sitting down and doing the maths on, because it compounds every single year you wait. Let's move on to tax, because this is where a lot of confusion has crept in this year specifically. The government made a decision that's been described by some as controversial. Pensioners who rely solely on the state pension will pay no income tax, even though the payments now exceed the frozen personal allowance of £12,570. The Chancellor framed this as easing the administrative burden on pensioners, but not everyone is happy with how it's been handled. A former UK pensions minister described the arrangement as a complete mess, warning it could entrench unfairness in the system further. Why does this matter to you? Because with the personal allowance frozen and the state pension continuing to rise under the triple lock, the two figures are getting closer and closer together every year. With the latest increase, the flat rate state pension now sits just £22 shy of the personal allowance. If you have any other income at all, a small workplace pension, part-time work, savings interest, you could be pulled into paying tax in a way you weren't expecting, even if your state pension alone stays untaxed. This is exactly the kind of thing that catches pensioners out at year-end. So it's worth checking your total income picture now, not after your tax bill arrives. Morningstar Plus 2. Now let's talk about money that pensioners are leaving on the table entirely, because this is where the real damage is happening. There is a benefit called pension credit, and the evidence suggests an enormous number of eligible pensioners simply aren't claiming it. Pension credit tops up weekly income to £238 for a single person and £363.25 for a couple, and the government estimates it's worth £4,300 a year on average to those who claim it. That is not a small amount. That's life-changing money for someone living on a tight budget, and it's sitting unclaimed because people assume they won't qualify or they've simply never heard of it. Here's why pension credit matters even more than the headline figure suggests. Claiming it can unlock further support, including housing benefit, council tax reduction, help with NHS costs, and a free TV license for anyone aged 75 or over. So this isn't just one payment, it's a gateway to a whole set of additional support that many pensioners assume they're not entitled to. If you've never applied because you assumed your savings or your other income would disqualify you, it's genuinely worth double-checking, because the thresholds are often more generous than people expect. There's also a benefit that doesn't get nearly enough attention, and unlike pension credit, it isn't means-tested at all. Attendance allowance is not means-tested and can pay £76.70 or £114.60 a week for people over state pension age who need help because of a disability or health condition. If you're in Scotland, this support comes through a different scheme, the Pension Age Disability Payment, but the principle is the same. This isn't about how much you have in the bank, it's about your care needs, and it's routinely underclaimed because people assume disability benefits are only for younger claimants. Let's talk about one more myth that causes real financial harm, and that's the assumption that everyone's forecast is accurate and complete. A pension forecast can be lower than expected, sometimes by a painful margin, because of gaps from time out of work, moving abroad, low-paid or self-employed years, or missing national insurance record entries. The frustrating part is that many of these gaps are fixable. If you took time off to raise children, cared for a relative, or spent years working abroad, you may be entitled to national insurance credits you never claimed, or you may be able to make voluntary contributions to fill the gap. In many cases, you can make voluntary contributions to fill gaps in your national insurance record and increase the amount of state pension you receive, and you can find out more through gov.uk. This is not automatic. Nobody is going to fill these gaps for you. It requires you to actually check your own record and take action, and the earlier you do it, before reaching pension age, the more options you generally have. So let's bring this together, because there's a clear pattern running through everything I've covered today. The state pension system rewards people who check their own numbers and penalizes people who assume everything is being handled correctly in the background. It isn't. Your qualifying years, your contracting out history, your pension age, your total taxable income, and your eligibility for pension credit and attendance allowance are all things that sit on your side of the fence to check. The government provides the forecasting tools, but it doesn't chase you down to tell you that you're eligible for an extra £4,000 a year. You have to go and find that out yourself. Before your next payment lands, take 15 minutes and do 3 things. Check your state pension forecast and national insurance record online. Check whether you or your household might be eligible for pension credit, even if you think you earn too much, because the threshold is often higher than people assume. And if you're still working past pension age and don't urgently need the income, seriously consider whether deferring makes sense for your situation. These aren't complicated tasks, but they're the difference between quietly accepting whatever number appears in your account and actually claiming everything you're entitled to. Pension rules in this country are not designed to be simple, and they change more often than most people realize. What was true 2 years ago isn't necessarily true today, and what's true today will likely shift again before your next birthday. The pensioners who come out ahead aren't the ones with the biggest savings pots. They're the ones who stay informed and check their entitlements regularly, instead of assuming the system will flag it for them. If this video helped clear up even one thing about your pension that you weren't sure about, that's exactly why I make these. Pension rules affect millions of people in this country, and far too much of this information is buried in government paperwork nobody has time to read. I'm going to keep breaking these changes down in plain English, video by video, so you always know exactly where you stand. So do me a favor, subscribe to my channel so you don't miss the next update, because there's more changing this year than most people realize, and I want to make sure you hear about it before it affects your payment, not after.